This mistake cost me $17,400 and nobody warned me it was coming. I sat there watching the screen, paralyzed, as years of hard work evaporated in a matter of hours. It wasn't because I picked a bad company or because the economy collapsed. It was because I fell for a trap that looked like a smart move. Today, we are exposing the investing mistakes that cost you thousands. We are talking about buying safe stocks that quietly destroy your purchasing power, trying to time the market like a genius, only to realize you are actually gambling, and the one specific mistake that feels incredibly productive but actually ruins your long-term returns. Stick around until the end because mistake number 7 is the most common error in the financial world, and it is easily the most expensive one you will ever make. This video is for the person who has already started their journey but feels like they are running on a treadmill. You are putting money in, you are doing the research, but the numbers just aren't moving the way the calculators promised. Maybe you have lost money recently and you can't quite put your finger on why the strategy failed. I want to be clear, these aren't just beginner blunders. These are normal mistakes that very smart, high-achieving people make every single day. I have seen these specific errors wipe out years of potential gains for people in their 20s and people in their 50s alike. We are going to fix that right now by looking at the hard data behind your portfolio. Mistake number 1 is starting without a concrete strategy. Most people don't actually invest. They participate in a form of high-stakes cultural gambling. They buy a stock because they saw a headline, or because a friend mentioned it at dinner, or because a certain ticker is trending on social media. This feels productive because you are taking action, but activity is not the same as progress. When you invest based on hype, you are essentially flying a plane without a flight plan. You have no timeline, no exit strategy, and no idea how that specific asset fits into your overall life goals. The danger here is that without a rule-based approach, every decision becomes emotional. If the stock goes up, you don't know when to take profits. If it goes down, you don't know if you should hold or cut your losses. This inconsistency is a silent killer of wealth. A quick fix is to implement a simple rule-based system before you ever hit the buy button. You need to define your time horizon. Are you holding for 5 years or 20? You need to define your risk level. How much of a drop can you stomach without losing sleep? Most people think this lack of strategy is the worst mistake you can make, but it actually gets much more deceptive than this. Mistake number 2 is confusing a great company with a great investment. This is where the smartest people get tripped up. We often fall in love with brands we use every day. We see a company providing incredible service, dominating their industry, and hiring the best talent, and we assume that because the company is winning, the stock must be a buy. But a great company can be a horrible investment if you pay the wrong price for it. Investing is ultimately about the relationship between price and value. If you overpay for a world-class company, your future returns are mathematically capped. You might wait 10 years for the stock price to catch up to the valuation you paid on day 1. This is why basic valuation awareness is vital. You don't need to be a Wall Street analyst, but you do need a price-to-earnings mindset. You have to ask yourself if the growth of the company justifies the premium you are paying today. Buying a great business at an inflated price is one of the fastest ways to see your portfolio stagnate for an entire decade. Remember, the market doesn't care how much you like the products. It only cares about the cash flow relative to the share price. Market timing is mistake number 3. It feels wise to say, I'll wait for the crash to buy in, or I'll sell now and buy back when things settle down. Statistics show this is one of the most expensive stock market techniques. Problem: the market's best days often coincide with its worst. If you miss a few of the best days in a decade while waiting for a better entry, your returns may be halved. Usually you wait for a dip, but then you get scared and wait for it to drop farther. Recovery is complete by the time you feel safe returning. Panic selling and reluctant buying might cost thousands. The quick fix is dollar cost averaging. Without being psychic, you can invest a certain amount at regular intervals regardless of price. Rules must trump emotions to achieve long-term wealth. Excessive trading and tweaking are mistake number 4. In practically every other sphere of life, tougher labor and more modifications improve results. The contrary is often true in investing. Doing something to get returns has been ingrained in us. We check the app 10 times a day, switch funds, and wait for the next big wave. Constant activity leaks wealth through fees, taxes, and emotional weariness. Every time you trade, you are potentially triggering a taxable event that eats into your principal. Your broker might offer zero commission trades, but they love your high activity because it provides them with data and liquidity while you shoulder all the risk. Real investing should be boring. It should be like watching paint dry or watching grass grow. If you are looking for excitement, go to a casino. If you are looking for financial growth, make fewer decisions. The most successful investors are often the ones who touch their portfolios the least. Ignoring fees, taxes, and friction is mistake number 5, which seems harmless but drains your money over time. A 1% management fee or expense ratio may not seem like much in a single year. You think it's just 1%. That 1% can consume 30% or more of your eventual nest egg over 20 or 30 years due to compound interest loss on those wasted dollars. You lose the fee and all it may have earned you over the next 2 decades. This friction is a huge obstacle to financial freedom. Index fund expense ratios and account type taxes must be closely monitored. Income preservation requires tax-advantaged accounts and low-cost funds, not just a nice-to-have suggestion. Every fee-free dollar works for you forever. Insufficient or faux diversification is mistake number 6. Having 10 technology stocks doesn't make you diversified. Having 5 cryptocurrencies and 3 high-growth tech equities makes you extremely leveraged on one outcome. This frequent fallacy causes sector rotation portfolio wipeouts. Genuine diversification implies having assets that move in different directions. It involves exposure to various businesses, locations, and asset classes. An intricate portfolio with 50 lines is unnecessary. Complexity sometimes conceals strategy and adequacy. You need broad exposure to safeguard you when one section of the economy suffers. True diversification protects you from being wrong, because everything in investing is incorrect eventually. Mistake number 7, letting emotions rule, is the most harmful. This kills money. The smartest strategy, lowest costs, and most diversified portfolio in the world mean nothing if you can't manage your reaction to a red screen. Market cycles are driven by fear and greed. Greed makes you buy at the top because of FOMO. To avoid losing another dollar, you sell at the bottom out of fear. The average investor underperforms their funds due to emotional instability. Late buyers leave early. Automate your decisions to avoid this. Before the market opens, set your rules. Write down your strategy for a 20% market downturn. If you wait until the drop to plan, your brain will be in fight or flight mode and you will likely make a mistake. Due to lasting capital loss rather than transient swings, this mistake costs more than all others combined. You need a do this instead structure to avoid these mistakes. Set a goal first. For retirement, a house, or generational wealth. Second, pick a long-term plan you can stick to when circumstances turn bad. Third, put tax efficiency and reasonable fees first. Fourth, consistency. Boring investing makes money. Building a machine that works while you sleep is the goal, not a stressful second job. Investment mistakes are part of learning, but they don't have to ruin your finances. Have you committed any of these mistakes? I made numerous, and acknowledging mistakes was the first step to building riches. Comment below to discuss. In the next video, I'll show you how to invest wisely on any budget, even nothing. Subscribe to stop guessing with your money and start building a reliable future.